Hello, everyone. Welcome to the 2018 Hong Kong IFX Expo, jointly organized by Finance Magnates and Conversion Pros. We're going to have over 4,000 people present here today and counting, so I hope you're all excited and ready. This time, we're opening our content session with the cream of the crop, the Crown Diamond, the CEO panel. Those distinguished participants will discuss the most burning topics of the trading industry in Asia, from technology integration to acquisition and localization, and of course, cryptocurrencies. So, my colleague Victor, take it from here.
Thank you, Michael. So our crowd diamonds are ready to discuss the most vibrant issues in the industry with you guys. And let's start with their introduction, which will present to themselves. Adam?
Good morning. My name's Adam Reynolds. I'm the CEO for Saxo Bank in Asia Pacific. As you may or may not know, Saxo is present in hub in Singapore, and then we have offices in Singapore, in Sydney, Tokyo, Hong Kong, and China. And most recently, we have had an investment from Geely, the large Chinese company. So we are in the process of transitioning from being basically Danish-owned to becoming a Chinese company. So we've got a very interesting couple of years ahead of us.
My name's Andrew Ralich. I'm the CEO and co-founder of 10 Financial Systems. 10 is a US headquartered company with offices in Europe, Australia, Singapore. We provide technology to leading retail brokerages around the world, including bridging, aggregation solutions, infrastructure, and connectivity.
Good morning, my name is Gavin White. I'm CEO of Invast Global, based in Sydney. We're a multi-asset prime broker, boutique prime broker. We have a very large listed parent company in Japan, and from Sydney we service clients from all over the world, hedge fund clients, brokerages. Our team from Sydney is travelling constantly, and we've had great expansion over the last few years.
Hi everyone, my name is Mario. I'm the founder and CEO of Fullerton Markets, one of Asia Pacific's fastest growing brokerages. We are headquartered out of New Zealand. We are a proud sponsor of the Hurricanes, who has World Rugby Player of the Year, Beauden Barrett, who won the titles in 2016, 2017. We offer a whole range of instruments from Forex, CFDs, metals, with a primary focus on Southeast Asia and Asian clients. Very, very excited to be here with my fellow panelists. Looking forward to a great discussion. Thank you.
Hi, my name is James Pierron. I'm former CEO of ILQ, currently the CEO of BrokerMate. I still actually own my interest in ILQ. My differentiation would be I spent the first 7 years of my career as a fintech provider, and then I spent the next 7 years actually owning a NFA-regulated and ASIC-regulated broker. So I got to see the difference between fintech and broker. So I'm going to bring that unique perspective to the panel today. And we're releasing our, I'm going to call it the silver bullet, because Drew Niv was on the panel a couple of years ago, and he said there's no such thing as a silver bullet. That is an all-in-one solution. We call it the BrokerMate app, and I'm happy to be here and talk to you about that product today. Thank you.
All right, guys. So it's been quite a year, and as we probably agree, the most vibrant developments have been in regulation. And I'm going to start with the reason why regulation is rising over the horizon, and that is probably in part due to the business models that brokers use. So how do the various broker business models in terms of DMA, market making, ECN, hybrid solutions are impacting brokers, clients, and ultimately result in regulatory action?
Interesting use of the term vibrant. I'm not sure anyone would describe increasing regulation as vibrant. Certainly it's not a lot of fun. But yeah, it definitely has been the big focus of the year gone. Obviously preparing for MiFID II has probably cost all of us a lot of time and effort. But you know, the regulation, the increasing regulation, is all about consumer protection, and you know, consumers do need the protection, I believe, of regulators, and we embrace the regulation that there is. I think when you start looking at the various business models that are around, it really is a question of how protected the clients are under the various business models, and what the incentives are for the broker to protect their clients. So, you know, if you're out there offering 200 to 1 leverage or 400 to 1 leverage, there's a reasonable chance that you're not protecting your client quite so well, because the probability of your client losing money is exponentially higher when the leverage goes up. So when we look at the different business models that are more around sort of the DMA model, how you access the market is probably less important than how you help your clients risk manage their portfolios.
All right, Gavin?
I think it's very, very important for the industry and individual brokers to be ready for regulatory change. Regulatory change will undoubtedly continue. There's a trajectory that the regulators are on that I don't think they will be swayed from. I think one of the best things that we have done at Invast Global is to prepare ourselves and be ready for the change that's already happened, and be prepared for what we think will happen in the next 5 to 10 years. It is a repeat of history. We've seen this sort of regulatory reform happen 100 years ago, and it took 60 years for those reforms to be chipped away and then finally repealed. I think there's everything to say that the same time frame will happen with the regulatory reforms that we've seen that have come about in response to the global financial crisis. And I think that it really is important for the industry, but each of you looking after your own businesses, to be ready for the regulatory change, the impact of things that have already been put in place, but also be ready to predict what will happen in the future with further change. And I think that one of the important things is to recognise that some of the asset classes that we focus on now, FX for instance, they are very much under scrutiny of the regulators around the world, even in some of the jurisdictions which have traditionally been a little bit more accommodative. So I think it is very important for the industry and brokers to start to look at some other asset classes and diversify their exposure, or diversify their specialisation away from just the one asset class, because I think it will continue to be under scrutiny.
So, James, are you ready to speak more about the business model of brokers, and how do you think that they are prepared or not that prepared for the storm that is coming?
Well, I think I'm going to definitely be the disruptive person on the panel. I can just warn the audience and the panel now. DMA and STP and ECN, all these things, they're not business models. They're risk management strategies. So in the end, the client is trading with the broker. And I don't care what you want to advertise. And I think STP, behind STP, I think it's inferred that the STP broker is bringing bank liquidity or tier one bank liquidity to the client. And that's just not true. And we've seen that with FXDD, with FXCM. We've seen this every 2 years. When a third of the market disappears, we see that this is not true. So liquidity is never being brought from the bank to the client. The client is trading with the broker, and the broker may choose, as a risk management strategy, he may choose to hedge out that position. He may choose to do it quickly, or he may choose to hold what's called an inventory or a B book. But that doesn't change the legal relationship. So I think first and foremost, we have to change the definition of the terms that we use to market. So there is no ECN, there is no DMA, there is no STP. It doesn't exist. It's purely a risk management strategy. And so first step to answer your question, to bring it full circle, is the regulators need to understand this. So I have a lot of experience with regulators. In fact, in my first CFTC regulated firm, I hired the 2 top NFA regulators, so 2 top guys that anybody that was above these guys was on the board of directors. They didn't participate in the field. And I brought these 2 individuals into my firm, and I can tell you firsthand, they have absolutely no idea how to regulate the market. So we can talk in the abstract here, and that's fine, but if we want to get down to the brass tacks and talk about how to regulate the market, exactly how you would do that, first and foremost, we'll have to regulate the educate the regulators. And I don't think that's an easy thing to do, but it has to be done.
Okay.
Can I share some thoughts here, Victor?
Yeah, go ahead.
I agree with James and the panel in a sense that regulation will be there. But I think one aspect, we have to really understand what terrain we are in now. Let me give you an example. So I am very focused in the Southeast Asian market, the China market. I live and breathe in this region. And one of the key things that I've noticed, and this may add some value to our partners here, many clients, they, in a sense, you have to segmentize where they are. So I'll give you an example. In countries like, say, Indonesia, China, they technically don't really care, are you a STP, are you a ECN, are you a DMA, are you a market maker? They just want to make money, right? In China, 他们只要赚钱。我不管你是 STP 还是 MM， 我要赚钱。I want to make money. That's all they care, right? If you go to slightly more mature markets, for say Singapore, Malaysia, Thailand, they do dig deeper. They do want to understand, okay, so what kind of a business model are you? So I think regardless of whether or not what kind of model you are in, number one, regulation will happen, all right? James made a great point. We have to educate the regulators. At some point, they are also feeling around. They don't really understand what kind of market we are moving in. So while regulation is going to happen, the answer is yes. I think on a more important point, we need to understand the terrain that we are in. Sun Tzu called this, to understand the terrain that you are fighting in, right? And I think that will help kind of for our partners here to plan their path.
Okay, Andrew?
So I think the word that hasn't been keyed in on enough and is of most interest to brokers in this room who are sitting in the Asia Pacific market is the word Gavin used and Victor used of preparedness, prepared. How do I prepare my broker, regardless of my risk model, regardless of exactly where I'm sitting in this market? How do I prepare for the inevitability of regulation as I'm looking into the Western side of the industry that is seeing this regulatory wave pass through? I love doing business in the Asia Pacific market because it's a microcosm of this industry that you use the word maturity. It has been growing. The regulation is coming not in the same pace that we've seen in the U.S. 1-0 entered this market in 2009 as the NFA swept in. James hired all their best guys, but they took over the U.S. space in a way that was quite constricting.
I wouldn't say, sorry to interrupt, it wasn't constrictive. One of the big mistakes I made with dealing with the NFA and the CFTC is I thought their strategy was to regulate. And so that's why I hired their employees, and I tried to be as compliant and as transparent as we could. And I was even a little arrogant about it because I thought, shit, I understand this better than anybody, and if we're not compliant, then nobody's compliant. But what I failed to recognize, and I think the Asian culture understands this really well, is know your enemy. And in this case, and you see this, right? The CFTC went from 300 brokers in 2010, 330 to 3. And the only reason there's 3 left is because they're publicly traded companies and they can't get rid of them, but they tried. So the CFTC strategy was not to regulate, it was to eliminate. And now you're seeing the same thing in Cyprus. They're starting to introduce some, the head of the Cyprus, head of CySEC, she's under tremendous pressure. And pretty soon, I'm not going to predict the future, I don't know what's going to happen, but I can tell you if it continues, they're going to get rid of CySEC as well. So,
well, James, hold on one second, because I don't think any regulator has a goal to eliminate this market. I think to Adam's
I don't think
point,
the CFTC...
Excuse me for a second. They have a goal to protect their clients. And so going back to the point of preparedness, how do I prepare my broker for a sweep that's going to eliminate business practices that like high leverage, like bad risk management policies, to be prepared for this sweep, you want to build into your business a foundation that takes insight from these previously regulated markets. So if you're building a brokerage in Asia today, and the basis of your marketing is 400 to 1 leverage, you already have insight. You have a crystal ball into the future of this market by looking west. And you have the ability, and a very unique one, to experience this fast forward regulatory pressure by looking at brokers who are maintaining and succeeding in a regulated market. We have clients in the US, we have clients in Europe still, and these are the brokers that made decisions early on to invest in transparency for their clients, to not rely on dodgy marketing practices in order to win business. And when the regulation comes in and your competitors fail, you get to sweep up the remaining business. Sure, it's at lower leverage. Sure, it requires more regulatory onus, but it's better for clients. And it's not a regulator trying to kill the industry, it's a regulator trying to kill the practices that are not fair and bad for the end client at the end of the day.
Thanks for your opinion, but it's just not true. The CFTC, and then I know this personally, coming from Chicago, their strategy was to eliminate. And you touched on, you're touching on little drips, right? You're talking about marketing practices and leverage. These are little tiny drips in terms of the entire regulatory framework. I mean, we still need to talk about fair price, best practice, insolvency, AML, KYC, and then underneath these, there's hundreds of sub topics as well. So I can tell you firsthand that the regulators, and I've dealt with 4 of them, have absolutely no idea what they're doing.
Okay,
Can I just
maybe in order to make them understand what they're doing, ultimately their goal, it should be to protect clients.
Sure.
So how do we help clients to not lose as much as they are losing?
Well, I think it is dangerous a little bit to underestimate the regulators, and it's also dangerous to take too short-term a view. I think we as an industry, and certainly brokerages throughout the world, it is the job of management to have a long-term view and to move your business model towards a business model that's going to win in the long term. And I think it's very, very dangerous to try and swim against the tide. When the tide is going one direction, it is our jobs to sense that and position ourselves to benefit from that. And I think that in the long term, the regulators around the world want us as an industry to move our business models and move our product offerings towards a more investment style offering and away from a short-term speculative style of offering with high leverage and the like that we all know. Not only that, it's not just important for us as managers and business owners to be sensitive to the tide of regulation and what the regulators want the outcome to be, but there's also massive opportunity. There's massive opportunity in moving more towards an investment style offering, a true investment style offering. The middle classes throughout the emerging markets are growing. Their interests and their desires are going to become more and more sophisticated. They're going to be calling out for tools, more investment style tools, more asset classes to diversify across, to be more sophisticated in the way in which they approach the markets and the way they manage their money. And as an industry and as CEOs, we need to build our businesses to take advantage of that and give the clients what they want, and also be sensitive to the way the regulators are trying to edge the industry.
Actually, I couldn't agree more with Gavin than on that. For me, for us, we think that client education is very key. Getting them to understand what it is they're investing in, getting them to understand the concepts of asset allocation, of portfolio allocation, of geographic diversification, and giving them the tools so that they can analyse what they've got. So having multi-asset, having equities, having bonds, having futures, having FX in one portfolio where people can see what is going across their entire portfolio and what the different risks are across their entire portfolio is definitely a big help in helping clients to be more profitable. But the big thing, I guess, when we're just focusing on the FX market, it is a question of leverage. If you have misaligned incentives with your clients and you benefit when your clients blow up, then that is not a good business model to have. So having a model where when your clients make money, when they survive longer, when they are doing well, you do well, is definitely a different business model and important for consumer protection.
Okay, so making traders into investors. Mario, from your experience, what do you think?
Well, my point is this. So far, what we've been discussing with regulators and all that, I think there's two key things that we can take away from this one question, right? Number one is called education. Number two is called engagement. There needs to be constant education, right? That's point one. We, as leaders of the industry, got to bring in all the technologies for the markets to come and be aware that such technology, such knowledge is out there. But the market has got to play ball. The market has got to say, yes, I need this information, because if you don't have information, you're still swirling in a black pool, so to speak. So number one, education is important. The leaders will provide that. The market needs to respond and say that this is important for my growth. That's step one. Step two, there needs to be engagement with the regulators, right? At some point, regulators are also swimming blind. All they know is that regulators step in for only three reasons. Number one is to protect the retail crowd. Nothing wrong with that. Number two is because of a lack of understanding. Oh shit, I better start regulating because it's something I don't understand. Number three, which not many people talk about, is because they don't have any revenues from all these things that's coming up, so they might as well just ban it first. That's probably the only three reasons why regulators step in. So,
That's right. And number two,
Let me
obviously
finish,
leverage
James.
is the low-hanging fruit, right?
right. So, education and engagement both needs to happen from 2018 forward. Do we want to work with the regulators? The answer is yes. But let's all do that as a proper ecosystem so that we all move ahead together. So education and engagement. Thanks.
But I think to a certain extent over the last couple of years, there's been a FX code of conduct that's been developed by the regulators in consultation with the industry. There's been representatives from many different parts of the industry, including the retail space, in developing that code of conduct. And I think that does set a standard by which people should live up to. And I think that firms need to be committed to the code of conduct in the way that they interact with their clients.
Okay, certainly. But breaking this cycle of traders losing client assets and some brokers stepping into the market very short term is also probably key. How do we do that, James?
Well, like I said, we're at a very abstract level, the way we throw these terms around. With the regulators need to regulate more, we need to educate them. But I've actually, over the last year, I've written a regulatory framework down to the smallest detail, and I can tell you it's very complicated. It's not difficult. It's just a question of leverage. Lowering leverage is like painting over the cracks. You're just painting over something because you don't actually really want to fix it. You don't want to take the work to actually fix the problem. And fixing the problem, it's difficult. And one of the great points that you brought up, actually, that I forgot about, that's brilliant, is also educating the clients. And I'll give you an example. So you'll see the DMA, the as low as 0 pip spread, the inverted spreads, all of these things, they're setting false expectations for the clients. It's lazy sales guys. Sorry, I know sales guys. It's lazy sales guys or a broker with no strategy and no product, so he sells tight spreads and he sells fast execution, and I've been hearing that for 10 years. So if you don't have a product, you sell tight spreads. And sometimes they get so tight, especially if you aggregate, they have negative edge. When a trade has negative edge, you can't do anything with that trade. You can try to pass it off to somebody else, but then they're going to lose money. Somebody's going to lose money. LPs are going to switch you off. And eventually, the broker will start doing, he'll start prop trading, or he'll start doing some of the things that brokers do when they're about to go out of business. And when you're faced with going out of business, brokers start making unethical decisions. And so it's exactly what you said. It's everybody has to change. The entire industry has to change, from the client to the regulator to the brokers to the technology providers, because the technology providers, Andrew, they're selling aggregated feeds. An aggregated feed is an off-market price by definition. And when you trade on that, you have negative edge. It's a hot potato. Somebody gets it, somebody loses. And if you follow that trail, it'll eventually lose to insolvency.
Technology providers.
I'm not going to respond to the aggregation point because I don't understand it, and I don't think it makes sense. But
Of course you don't.
I'm going to speak more back to a point that Gavin and Adam made that I think is very interesting. We're speaking here like we exist in this financial vertical microcosm that is in a vacuum and insulated from every other market. There's plenty of precedents and plenty of prior art for regulators looking at the FX space to figure out ways to protect clients. The securities markets, the futures markets, develop.
These are
throughout the
centralized
world.
markets. They're
James,
not
stop
decentralized.
interrupting
I'll
everybody.
interrupt if I want.
In these markets, what we're seeing for demand from our clients is looking at a futures and equities product alongside an FX, embracing this tighter leverage, this different market, which frankly, it is a more fragmented space. There's no central point of execution. It's what makes FX so exciting from a technology and brokerage perspective, because you get to show a unique price in an OTC market. But mirror regulations bring in assets alongside your FX offering that have a foundation in financial markets that is well regulated, established, and fair to clients. And you'll be able to get ahead of this wave of the FX market changing so rapidly that we feel like it can't exist anymore. There's plenty out there to learn from.
Yeah, can I just add to that? I mean, Saxo has had a multi-asset platform for a long time. It's a great platform. I think you guys have done very well with that. But I think one of the biggest developments for the FX industry over the last few years, without doubt, has been the introduction of MT5 and the ability for MT5 to have exchange connectivity and multi-asset. I know Andrew at 1-0 has worked very hard, is probably leading the field in terms of connectivity to that particular platform. I think that's something that we really need to embrace. The time has come for that offering now. I think the multi-asset offering. Like I said, Saxo's had it for a long time, but for people that are using the MetaQuotes platforms, which is obviously one of the most popular in our industry, it really is time now. The regulatory pushes towards that. Clients are requesting more asset classes to enable them to be more sophisticated and diversify. And now we've got the likes of companies like Andrews that are enabling that connectivity. And I think that's something that the time is right, I believe.
Do you want to join our marketing team, Gav?
So you brought up a point about multi-asset, and in terms of marketing strategies for the APAC region, this has been a global trend, but can you identify some specific differences between the rest of the world and the APAC region on the marketing front?
Yeah, I mean, obviously, the APAC region is client rich or people rich, so there's a lot of ability to get clients on. I think when we start talking about investor versus trader segment, which is how we segment our clients, the ratio of the number of investors to the number of traders is quite consistent around the world. So we're talking somewhere in the region of between 10 and 20 to 1. So your cost of acquisition of investor clients is significantly lower than your cost of acquisition of trader clients. So I think there's a lot of similarities about that around the world. But in behaviour, I think Asia has a much more trader-focused culture. People do like trading. They do like value. They do like self-directed, perhaps more than sort of old school Europe, where they're much more happy to turn around to their private banker and go, "Here, you can manage my money for me. I'm going to deal with my other businesses."
Can I, from a macro perspective here, a very interesting conversation I had with a broker client in Thailand yesterday as compared to the rest of the world. So not speaking as much about the investor, but broker sophistication. The Asia Pacific market is very interesting because many of you are familiar with futures markets and have traded bullion or gold prior to looking into the FX space. So whereas I'll walk into a Cypriot broker and explain like, listen, multi-asset is a trend and you have to pay for the market data from the CME. And they say, I have to pay for quotes? I've had my FX data for free for 10 years. Why? And this education process is much different in Europe, wherein I'm speaking to a Thai broker who says, yeah, of course, if we're going to take a CME feed, we're going to have to pay them for market data distribution, and we were surprised to see that we could get FX for free. So interesting kind of juxtaposition in this market from our perspective, having been exposed to more developed futures exchanges and kind of the other side of this space, and now bringing FX into the fold.
Okay. Mario?
Yeah, for marketing strategies per se, right, when it comes to Asia Pacific versus the rest of the world or versus Europe in particular, I would focus a little bit on the intangibles, right? The tangibles, I think many of us understand it. Provide education, do this, do that. Two intangibles that I think are very important for marketing competition. Number one would be relationship building. That's why I consider it as intangibles. Relationship building is important. Number two, the understanding of local knowledge. I'll give you a perfect example of this. 2 years ago, if you are familiar with Grab, the ride-hailing app, Grab and Uber, all right? So Uber is taking off more in the US, in Europe, but in parts of Asia and Southeast Asia, it's more Grab. And why is that? So when Victor asked a question, right, what is this versus that, Asia Pacific versus the rest of the world, I'm going to show you an exact comparison between Grab and Uber. And Anthony Tan, a guy who got 700 million funding from a SoftBank, which means it works, basically says, I compete based on local knowledge. So if we can understand that, especially if some of the people in the room, if you're competing in Southeast Asia, you've got to understand the local knowledge. I think that is where you bring in a fresh piece of competition. And there's no two ways about it. Even we as leaders, we can't just simply go hire a local guy, okay, go out there and win the market. To raise the bar, I think at some point, even we have to go down to the ground. And that is absolutely necessary. Okay, so 2 points when it comes to marketing strategies, intangibles, relationship building, and understanding of local knowledge.
Okay, so James, what do you think? How do the difference, how does the world differ in Asia?
I'll be honest, marketing's not my forte. I'm on the operational side, pricing, risk management. I've struggled with marketing my whole life. I'm hoping our booth over here is BrokerMate. You can check it out, and maybe I'm making some progress. But I generally stay in my laboratory, and I'm just not a marketer. The only thing I would say is that I think every client should have really only 2 things should concern him, and that's, did I get a fair price? And I've worked on this extensively over the years, is fair price. And it's a very difficult thing. So there was a transaction, a client conducted a transaction with a broker, and this I don't think it matters if it's even financial. I think it's anything. When you buy something, did you get a fair price? Now, what makes that difficult in OTC derivatives is the price is changing. The price can change 100 times a second. In fact, on the euro dollar, the mean right now is about 126 times a second. That's 126 times a second the price changes. That's an enormous amount of volatility. So if I'm the client, I want to know I got a fair price. If I'm the regulator, I want to know that the broker gave the client a fair price. And secondly, so that's one thing. And secondly, I want to know if I win, am I going to get my money? It's really all I care about. Is the broker solvent? Is he doing the right things in terms of risk management and operations to make sure his operation's solvent, so when I win, I get paid? So I know that doesn't have much to do with marketing, but if I was a client and you marketed that to me, I'd say, okay, yeah, these guys are thinking about the right things.
Okay, I disagree with James, and here's why. All right? He made a great point, but this is basic today. Basic meaning to say, if you offer a fair price and the broker is solvent, when I want my money, you better pay me. I think this is basic today. Let me give you a perfect example, okay? So if you look at Intel, you find the Intel chip today in Samsung, in Apple, in Dell. It's the same thing. Many people who say, oh, as long as you give me a fair price, it's fine. No, it isn't. Today, if we're going to up the industry standards, there's got to be more than that. So we can't just say, oh, I have a fair price. 100 other brokers have fair price as well. Let's compete even higher. Let's look at things like the strength of management. Let's look at innovation. Let's look at marketing strategies. Let's look at communication services, how we deal with clients. So competing on fair price and ensuring a brokerage is solvent is basic. 华语我们讲是基本的，这些你们应该都有了。Okay, you should already have it. Let's move it higher, 2018 and beyond. Let's blow the roof off this entire industry and compete and bring the entire industry up together.
Sure, but before we build the house, let's have the foundation. And I can tell you, I can analyze any broker in this room and tell you that their prices are not fair. I guarantee it. And I'm not saying that they're unfair. I'm saying they're random. Sometimes they'll be fair and sometimes they're not.
You're not getting better at marketing, James.
But I can tell you, brokers do not have fair price figured out. It is rocket science, very difficult. Deutsche Bank, Bank of America, these banks have spent decades, hundreds of millions of dollars on their pricing engines, and you can't just plug in a piece of technology you download from the internet and call it a pricing engine.
I'll take this question for the industry. All right, gentlemen. Now listen to this, James. This is why I say understanding the terrain is so important. Scan around the entire room. The bulk of the people in this room are mostly from the sell side. Okay? Where are the people that are the big IBs, the big white labels, are they in the room? For us to have a meaningful discussion, the people that we market to needs to be in this conversation. All right? So that's point number one. I mean, hopefully for the organizers, just bring these people into the room. So this is step one. Step two, if it's just based on fair pricing, and this is something I tell my clients as well, I can't give you the best spreads because for me to compete in Southeast Asia,
Spread has nothing to do with price.
I need to pay the IBs.
Nothing to do with it. You're conflating issues. A fair price and a fair spread are two different things.
James, the key thing is when it's fair pricing, this is step one. I agree with you. I agree with you, okay? One of the key points when I'm saying we have to understand the terrain in which that we are playing. For an example, if clients comes to me and say, Mario, can you give me this, can you give me that? If we can't, we hand it over to some of our other industry partners because we don't take the clients. Clients today are very demanding. You know this. Many of our panelists know that, right? So choosing the client is step one. The day has come where we all of us need to be educated. There are many clients I wouldn't say in the room, there are many clients in Asia Pacific. They're asking for things that some of the panelists or even the brokers can't give. In which case, then they move out, and that is fine. That's why I always say we have to compete based on the USPs of each firm. If it's fair pricing, it's fair pricing. If it's management, innovation, customer service, and there are clients who do want those kind of things.
Okay, so one of the trends this year, we can say that probably it's part of marketing, has been to offer cryptocurrencies, just because of the volumes of Google search. What do you guys think? Is this a blip? Is this last year was last year a blip in the giant timeline that we're living in, or just a more sustainable trend? Andrew?
I'll take it first. How about you go first. So cryptocurrencies has been a very, first of all, they've existed for much longer than just the last 12 months when they've become incredibly prevalent in conversations we've been having with brokers, we've been having with other participants in the industry. My take on this space is we have a new asset class. It happens to be the new least regulated asset class available. I use the term exotic commodity to describe a cryptocurrency. I think it should be and will eventually be regulated and treated like a commodity. Looking more broadly at the space in general, our space, our industry, if you reinvented your business model 6 months ago to introduce blockchain into your company name or angle your product so that it was now crypto focused, you probably didn't have a very good business 7 months ago coming into this new tidal wave of trend and popularity. Last year I sat on this panel and I said, unfortunately there will be a lot less binary options brokers in the room at this point next year. I'm happy to be right about that. I think that was a part of the space that needed cleanup. I think crypto will be here for decades to come. I think it is something that we will learn to adapt as an asset class alongside other asset classes. We'll learn to regulate it, we'll learn to understand it, we'll learn to secure it and protect it, which is an area where this space has a lot of maturity to gain. And interestingly enough, I think the OTC market has a lot of room to grow and play in this space. Right now, a close friend and client of mine asked me yesterday, what should I do if I just want to hedge some crypto risk? And amazingly enough, to everyone in the room, the answer is find a well-capitalized CFD broker who's offering you crypto. If you don't need to hold physical in that asset class, your biggest counterparty risk in that space right now exists with the exchanges. It exists with their infrastructure. It exists with their business models that have had tens, if not hundreds of millions of dollars injected on the back end of kind of a half-baked technology solution. So there are actually people in this room who are better providers and purveyors of that space than the actual exchanges who are the source of liquidity there. And so I do think it's a marketplace that we'll talk about for years. I just don't necessarily think reinventing your business today around this hype that's existed over the last 6 months is necessarily the right direction to go.
Gavin?
I think cryptos have been fantastic in terms of getting eyes onto our industry and bringing new traders into the industry, new clients, particularly at the lower age range. But I think there's a danger that they're a distraction for us long term as an industry. I think the hype is taking a bit of the oxygen out of the room where that should be, more focused on more long-term developments in the industry and more efforts put into trying to keep clients around for longer. So I think while it's been great in terms of attracting new clients to our industry, I do hope that those clients are able to stay around for long enough that they can be valuable to the industry. And I think that's where we as leaders need to try and work out ways to keep these new clients with us.
Fantastic.
Sorry, Mario. Adam wanted to...
Yeah, look, I think it's a very interesting market. We've got two Bitcoin ETNs and two Ethereum ETNs on the platform, and the volumes that we're seeing through them are very, very high. Beating Apple in some cases, which is quite interesting. But the cost of trading on an exchange, you're right. If you don't get your money back, then that's a very high cost. But even if you do get your money back, a round turn can be 5%, 6%, 7% when you include the credit card fees, which is exceedingly expensive. So I think what Andrew mentioned about finding a good broker who has a good product, looking at the cost of a round turn is amazingly important, because if you're paying 5% to 7% away every time, even if it's moving 20%, you're not going to make much money.
Mario?
I think we can't afford to ignore blockchain or crypto anymore. It is here to stay. The markets are divided. There are people who love it, there are people who hate it. So there needs to be, again, a discussion, as in, do we offer it, right? So naturally, some brokers are offering it. Here's two aspects that I want the room to take away with. Number one, the trading of cryptocurrency, and hence the offering from the sell side, is here to stay. Meaning to say, it opens up a whole new blue ocean market for everyone in the room. As an example, there were people in the retail side of things that never really wanted to trade on the Forex or the OTC derivative side of things. But because of crypto, oh wow, if I had put $100 in Bitcoin 7 years ago, I'll be worth $200 million today. That kind of things has an emotional pull to the retail market. And that's why everyone is jumping on the bandwagon. Having said that, everyone is aware what happened last week, right? When even Bitcoin dropped 50%. And this is where I meant the blue ocean side of things open up. Because when people lost money there, they come back to the OTC side of things. Oh, I think I'm going to stick to margin trading. I'm going to trade my FX. I'm going to trade my CFDs. I'm going to trade my oil, gold, silver. And that's great. So step number one, I think the blue ocean side of things with crypto has opened up. It's going to be good for everyone. Step two, and I'm using the words crypto and blockchain interchangeably here. I think if we can incorporate parts of blockchain technology and move forward, it is going to be a good thing. For your firm, for our firms, it is going to be a good thing. If the essence of blockchain is not lost, it is a distributed ledger. It is decentralized. There is trust. You can't go back and backtrack certain transactions that have already been mined and put on the block. That's a good thing. trust is something that's been lacking in the industry. If blockchain can solve that, it's a good thing, friends. So two things, blue ocean strategies, which will help everyone, blockchain technology, which should push everyone.
But
Ja-
if I can just make one more point.
Okay.
That using crypto as a marketing strategy versus a new asset class in a blue ocean, I think is a very important distinction I feel obligated to have people take from the room. The booth that I purchased from Finance Magnets or IFX is a marketing expense. It does not have unlimited downside risk for my company as an effect of taking it, staffing it, and being here. Putting an asset class out there that you don't fully understand, that the world has not completely developed yet, and using it as a marketing tool, even taking a loss on it in trying to bring in clients. It will certainly bring in clients. It will certainly, hopefully, open up new trading avenues and marketing avenues for the OTC market. It will also be a very, very sad ending story for a lot of brokers who have incorrectly taken this new asset class and blindly treated it like euro dollar and risk managed it on a bucket basis, or chosen. Right now there is an exchange out there who has been hacked and none of their coins exist that their clients think they have, and when that happens, if that's your hedge, you have a very difficult thing to explain to your CEO about how your marketing strategy ended up costing you your entire business. So please approach this new asset class with responsibility, excitement, but not necessarily unbridled, just sprint towards getting clients in and trying to just put this in front of people.
James, any last words? Maybe you could also chip in on how do we get fair execution in crypto?
It's exactly the same. So there's absolutely no difference between cryptocurrencies and any other derivative. We could today create a derivative called James Andrews, and it could have volatility, but risk management and pricing is the exact same regardless of the derivative. But when you move outside of that, so like as the panel mentioned, as you want to move from cash, from a fiat currency to crypto and back, I don't fully understand it, I won't claim to, but from the little bit of research I've done, the transaction fees are enormous. So that's one point. And the third point is, as my colleague here already brought up, is the security of it, right? It can just be gone. Or you can confuse an H to an L and it's gone, right? So there's other problems with cryptocurrencies that you don't see with derivatives. But on the trading a derivative side, there's absolutely no difference between a cryptocurrency and anything else.
Okay, well, we have to cut it off here, and our audience is welcome to ask some questions after the panel.
Well, thank you very much to Victor
Thank
and
you.
IFX.
Thank you, everyone.
Everybody.
Thank you.